Welcome to this Franklin Templeton Academy podcast in our series on managing equity volatility. In this series, we'll be joined by Academy experts as we examine the ups and downs of the equity capital markets. In today's episode, we'll explore these key questions. First, what's at the root of the ups and downs in the stock markets? What should smart investors keep in mind during volatile periods? Let's hear what an Academy expert has to say. Hello and thank you for joining us today. There are plenty of stories of people making it big and still more of people losing it all in the stock markets. What's behind these big ups and downs?
Well, stock market movements may be rooted in any number of macro or micro factors. Such movements get amplified because investors tend to move in herds, and stock market bubbles are really an outcome of human psychology. Let's first understand how the bubble grows. It usually starts just after a huge stock correction or crash has happened. At this point, most investors are skeptical, but the few who understand the markets see this as an opportunity to buy early. This is called the stealth phase. Smart money quietly picks up stocks that are typically undervalued in relation to their fundamentals because of negative investor sentiment. Smart investors invest quietly and stock prices gradually begin to increase. The takeoff is the stage where stealth phase ends and the awareness phase begins. Investors sense the momentum picking up and begin feeling more optimistic. Once institutional investors become aware of the opportunity and climb aboard, prices go up or take off, and excitement starts building. Individual and retail investors see it as a big lottery to be won. The fear of missing out then draws in more and more people. Believing it's a sure thing, some speculators borrow to buy in, planning on cashing out at the right time. So usually, the growth of this bubble is fueled by easy liquidity and increasing leverage. In the mania phase, the valuation of stocks is no longer driven by fundamentals but by greed and overconfidence that prices will keep rising. Speculators tend to ignore the signs that prices and valuations have reached unsustainable levels, and warning voices go unheeded. That's usually when the bubble bursts, often triggered by a sudden correction. Investors go into denial initially, but soon there is a paradigm shift in expectations and confidence levels. This is the blow-off that happens when people are least expecting it. Many try to unload their assets. There are few takers in the expectation of further price declines. The smart investors would have booked profits and pulled out much earlier. Latecomers to the party see their portfolios shrinking in value as the markets go downhill very quickly. Over-leveraged stock owners go bankrupt, leading to a cascade of other failures. There is no mathematical formula to predict precisely at what point a bubble will start and when it will burst. Those who get in early and get out in time to book profits come out winners. Those who don't see it coming and sell off in panic can lose it all. Speculators are usually most at risk here. But long-term value investors don't make decisions based on market sentiment. In a blow-off, they continue investing, picking up quality stocks based on their intrinsic value. Such stocks carry the potential of good returns over the long term. So they buy more stocks when prices are down and fewer stocks when prices are high, and bring down the average cost of their holdings through rupee cost averaging. They also know that the bear markets will eventually ease up and the market trends are cyclical, and that eventually the bulls will return. Historic data shows that on an average, bull markets have lasted longer than bear markets.
So, What should smart investors keep in mind during such volatile periods?
Here, I'd like to mention the wisdom shared by two famous investors, Benjamin Graham and Sir John Templeton. According to the father of value investing, Benjamin Graham, the individual investor should act consistently as an investor and not as a speculator. Sir John Templeton says that investors are people who buy for fundamental values. Speculators are those who buy in the hope of selling later to someone else at higher prices. So basically, investors need to base their decisions on real facts and analysis rather than risky, speculative forecasts or bets. Like we say, spending time in the markets is better than timing the markets. Long-term investors need to use rational logic to make decisions and not get swayed by the crowds.
And that brings us to the end of this podcast. Thank you for joining in. To learn more, do visit some of the other resources in our Managing Equity Volatility program. For those of you interested in the data references for the information shared in this podcast, you can download the infographic by clicking on the link provided. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.